Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today for an introduction to Visual Active Fair. Can you spot the closet indexer? And we are very pleased to have Dr. Wes Gray, the Executive Managing Member of Alpha Architect, to deliver today's presentation. But I've also got a colleague of mine, Emmett Peppers, who's going to give us a brief introduction, having worked with Dr. Gray for a while now, and let us know more to get today's session started. So, Emmett, I'm going to go ahead, if you would, give us a brief intro to Dr. Gray.
Thanks, Cynthia. Dr. Wes Gray is the founder of Alpha Architect, LLC, an SEC-registered investment advisor, and has been an advisor-client of Interactive Brokers for several years now. I've known him for a long time, and he's done very well partnering with us, and we've had a mutually beneficial relationship. I'm pleased to introduce Dr. Gray, who will present today's webinar.
Emmett, would you try with your phone once again? I'm sorry, we got very broken up audio.
Can you hear me now?
Oh, your audio is very, it's coming in and out.
Okay, let me try this one.
Let's see.
Can you hear me now?
Oh, you're still a little broken up. Well, what I'll do then, Emmett, just so that we can go ahead and get started, I happen to have Emmett's slides with me. Now, Dr. Wes Gray is the founder of Alpha Architect, an SEC-registered investment advisor, and has been an advisor client of Interactive Brokers for several years. And we're pleased to have him participate in our industry-sponsored webinar series. Also, very pleased to introduce you today to Dr. Gray, who will give today's presentation. So with that, I've already passed the ball over to you, Dr. Gray, if you can go ahead and get us started. Thank you.
Sure, thanks, Cynthia. So what we're going to talk about today is basically a new technology that we've been developing in-house that is going to try to help investors better understand what they're buying. And the intent here is I'm going to kind of give you an overview of the genesis of why we built this tool, how we currently have it in beta phase, and then really just looking for comments and help, suggestions to how to make this better for everyone. And the end state, in line with our mission of our firm, is just to empower investors for education. And one of the ways we do that is with tools and trying to make information easier to access and use. So what I'm going to talk about here, let's see here. So what I wrote about just recently here in the Wall Street Journal is you see this little girl with the 3 bowls of soup. And when you look at the asset management industry, there's always this trade-off between the asset manager wanting to get more assets and expected performance. And on one hand, you don't want to have a fund manager that has hardly any assets, because even though in expectation their performance might be pretty high because they don't have any sort of scale problems, there's a lot of operational risk. They may go bankrupt. They may not be around in a few years. They may not be able to invest the proper resources and research to actually generate their quote-unquote alpha. That may not be a great idea. And then on the other extreme, you have massive asset managers, which have tons of resources, tons of economies of scale, but they have too much money. Or, as Warren Buffett always likes to say, a fat pocket is not exactly good for future performance. So ideally, and in theory, there's kind of this equilibrium. We're in the middle somewhere where an asset manager's big enough to cover their costs, big enough to credibly survive for the foreseeable future, but at the same time they haven't been endowed with so many assets that they're essentially forced to only trade in the most large liquid securities, and or they have incentives to essentially be a closet indexer. And what we'll talk about here is that essentially the industry as a whole tilts towards closet indexing because it's a much better business model and eliminates a lot of the career risk concerns. So how can we introduce this? Well, 2 of the things that we like to talk about and do a ton of research on are value and momentum. And as we highlight here, value momentum are open secrets, right? Value's been around for at least 100 years. People know buy cheap stuff that everyone hates, and on average over long horizons that seems to be a reasonable strategy. And then momentum, buy securities that have strong relative strength, and that's been around for 200 years documented. And so these are open secrets. Everyone knows buy cheap stocks, at the margin, buy higher quality cheap stocks, and we know those characteristics tend to drive performance, at least historically. Same thing with momentum. We know we want to buy high relative strength stocks, stocks that are doing well over time relative to all others, and at the margin, we want to have a price path that is smoother as opposed to jumpier in general, and we call that quality momentum, but frankly, anything that has been performing well relative to other assets over the past 6 to 12 months, that's essentially capturing this momentum effect. So open secrets, very well understood by academic researchers, in theory well understood by practitioners. What do we actually see in practice? Well, first, what we have here in this table is statistics associated with equal weight portfolios. This is the compound annual growth rate, so kind of the annual compounded return that are associated with generic momentum portfolios. Where generic momentum portfolios are portfolios that are, the signal is based on what they call 212 momentum. So you take all the securities in your universe, we use the top 1,000 largest stocks in this universe, we then sort them on their last 12-month return, skipping the most recent month, and you buy the ones that essentially rank the highest. And now there's different ways one can form that portfolio, even though all these portfolios are based on the same exact signal, this 212 momentum signal. We have two dimensions that we can mess with as a portfolio manager. One is the number of stocks selected each month. So we could have a portfolio that holds 500 of the 1,000 securities. We could have a portfolio that's much more high conviction that holds 50 of the 1,000 securities. The other dimension that a portfolio manager can control is the frequency of rebound. So on this y-axis here, we have the holding period for each stock. The way you can think about this is 1 represents a monthly rebalance momentum strategy, whereas 12 represents an annually rebalance portfolio strategy. And what you identify pretty quickly is that performance is enhanced with more conviction and higher frequency rebalancing. If you look here in this quadrant up here in the upper left, we have 18.69 annual CAGRs. This is, all these results are gross of fees, and obviously this would be very expensive to trade, but one can, put in your own trading cost estimates and know that 18.69 is much higher than a portfolio that is diluted at 500 securities in the portfolio and rebalanced annually at around 12.69. The 1,000 stock benchmark for this time period generates around 13 to 14%. So in some sense, even before cost, a super diluted portfolio with a 12-month rebalance is actually not adding any value at all. So any portfolio can implement momentum. And the problem, though, is all momentum funds are not created equal. We want to own momentum structures or momentum strategies that follow a process that tends to move in this direction with more conviction and higher frequency rebalance. Of course, there's two trade-offs. The first trade-off is that as we move more and more high conviction, we get better performance, but we also limit the scalability of this product. Whereas a fund manager portfolio that has 50 securities in monthly rebalances, it's unlikely we're going to be able to put more than $700, $800 million in this thing, which is a ton of money, but to a large institutional investor who's trying to build a product, leverage the economies they have in their sales force, they'd rather launch a momentum fund that can take $50 billion. So it's going to be formed much more in line with down here in the bottom right quadrant are what we call asset collection portfolio designs. The other benefit from a portfolio manager standpoint to doing these more diluted, less frequently rebalanced strategies is they decrease career risk, in the sense that these portfolios are going to follow much more closely with just generic value weight or market cap weighted indices out there like the S&P 500. Why is career risk important? Well, career risk is important because asset managers get paid on AUM fees, and all else equal, they would rather underperform by a small amount and rely on their marketing efforts and sales efforts to keep those assets invested, as opposed to taking on the possibility that you could, one, beat the index by a lot, but also the flip side of that coin is you can lose a lot to the index. You could get beat by 10, 20, 30%, especially in a concentrated momentum portfolio. And if we're in the game as an asset manager just holding on to the assets, the last thing we want to do is take on a huge amount of tracking error, active share, where our careers could be at risk. So this is just results for momentum and highlights that alpha is going to be generated in more conviction, higher frequency rebalance portfolios, asset collection, and decreased career risk, decreased expected returns are going to be down here in the right quadrant. Even though all of these things could in theory be marketed as a momentum portfolio. Here are the same results using value, just generic value, just buy cheap stuff. Our favorite is operating income over enterprise value, but you'll see the same effect for low PE stocks, high book to market stocks. Whatever your favorite valuation metric is, you're going to see the same sort of patterns here. With value, it's less extreme than momentum, in the sense that momentum, the minute you stop having a high frequency rebalance, the returns drop off very quickly. With value, because it's I would call it a more long duration or long tail anomaly, sure, high conviction monthly rebalance value portfolios have the highest expected returns. Obviously, they probably also have the highest expected transaction costs, whereas annually rebalanced high conviction value portfolios still do well, but you are going to drop 200 basis points in expectation. And you also see the effect on conviction, where, again, with momentum, these things are magnified, but with value, you also see it to be the case that higher conviction portfolios right here, let's take this monthly rebalance 50 stock value portfolio versus the 500 stock value portfolio that's monthly rebalance. There's clearly a trade-off between conviction and performance. And again, looking back to the incentives of the asset manager versus the incentives of the investor, in theory, an investor is interested in long-term performance. So they would want portfolios that should be high conviction, high frequency rebalance, to the extent that we can do that in a gross of fee way that still adds value. And what we wouldn't want is a diluted portfolio with low frequency rebalance, because those performance figures essentially start bleeding towards the Vanguard fund performance. Whereas the Vanguard funds are essentially free, so if we're going to buy something that essentially acts like a Vanguard fund, why would we ever want to pay more than free for it? So if we're going to pay for active, let's make sure that we pay for the active risk that actually generates, this expected performance that we all are trying to go for. And it's critical that we understand portfolio formation in how this is being done, because as we're highlighting here with both momentum and with value, everything can be called value, everything can be called momentum, but how that portfolio is constructed dramatically changes the expected performance in that portfolio into the future. So one of the ways that we want to try to make this more transparent and easier to understand for folks is try to build a tool that helps people ferret out who's the closet indexer, i.e. who's the person that is really just an asset collector out there that says they're doing this momentum fund, but in reality they're not really doing much different than just the passive index. Whereas what we really want to be able to identify is someone who's building a portfolio construct that's actually exploiting this momentum factor, this momentum characteristic that we actually want to achieve. The problem with the marketplace for tools and information on trying to ascertain essentially who are these cause indexers out there is they're usually shrouded in math and in complex formulas where, even me, I got a Ph.D. from Chicago, I sometimes look at math equations and I don't even know what's going on. And in theory, I'm supposed to be a person that knows exactly what's going on, whereas pictures and visualizations, which is a lot of times more simpler, are a much easier way to actually understand data, in my opinion. And frankly, a lot of people are just not quantitatively inclined, and they'll act and nod their head in agreement, oh yeah, I understand what the active share is, or I understand what the tracking area is, when the reality is they're not really internalizing that knowledge. So one of the, I would say, the best technologies out there is active share, and the paper was written by a set of professors trying to find a way to how do we identify these portfolios that are actually being different than the index, and then try to ascertain whether they're going to outperform or not outperform. But one thing is certain: the only way to beat an index is you have to be different than an index. It's unclear whether being different is going to drive performance or not. That's where we'd want to understand the actual process, but kind of a necessary condition for outperformance is some level of difference. If you're just beating the index, you can't possibly beat the index net of fees and net of costs because you're just doing the index. So we want to, how do we identify people really being different, but let's make this tool easier and simpler and more intuitive for folks. So as we like to always say, a picture is worth 1,000 words, and that's where we've devised this visual active share concept. And here it is. So what I'll do is I'll orient you to the basic technology and the basic idea, and then hopefully after going through a few applied examples, if anyone on the call has input or insights or ways that can, maybe make this better or more useful for folks, we're all ears because we're actively in development on this and plan on launching this for free, obviously, so people can, be better investors. So what I'll do is I'll orient you to a live situation. The names have been hidden for just compliance reasons, and that's not the point. The point is to show how this tool can be useful. So the x-axis here is created by, what we do is we take every stock in the universe and we rank them on a valuation metric. We use, again, operating income over enterprise value. One could use book to market, one could use, P/E ratio, whatever it is. We're going to rank on a percentile basis from the most expensive stocks in the universe to the cheapest stocks in the universe, all securities. Simultaneous to that, the y-axis is quality. What we do here is we rank all securities in the universe, and in this universe there's around 1,000. It's basically domestic equity, mid and large cap. We rank everything on return on equity, just a very simple way to measure quality. And we rank all 1,000 securities, percentile rank that universe, and 0 is the firm that has the worst return on equity, 1 would be the firm that has the highest return on equity. Now, when we think about value investing and capturing the so-called value anomaly, what's very clear from the academic research is what drives the value anomaly is not factor exposures to HML or something like this. What drives the value anomaly is exposures to characteristics that drive performance. And those two characteristics are, one, cheapness, and which is by far and away the most important, and then the secondary axis where a characteristic we think can add value at the margin is quality. So ideally, we would have a portfolio that at the holdings level is concentrated on characteristics that we actually know drive out-of-sample performance in expectation. So this portfolio here with these purple dots is what we deem a highly active value strategy. And the reason it's highly active and the reason it is loaded on the characteristics that we want is this particular active value index is very focused obviously on cheapness. There's not a security in this portfolio that's not at least in the 20 percentile cheapest based on operating income to enterprise value. Then you also notice there's an extreme concentration on quality within the cheap bin. This portfolio here is trying to capture cheapness and at the margin get as high quality cheapness as possible because this particular portfolio thinks that cheapness and quality over time will drive the value anomaly. And then these dots right here are weighted in accordance with the position weight on each of these 40 or 50 different holdings here. This particular index is equal weighted, which is why the circles are all equal weighted because every security has the same amount of value attributed to it. Now, what we next bring up here, this next set of dots, is what we consider a quasi-active value index. So when we look to all the indices out there of people that are following some sort of value strategy, we found the one that we thought was the closest as possible to not being a quasi-indexer, and this is what we found. And what you'll notice is that this is the best we could find on the non-quasi-indexer, and there's a huge drift in weights where a lot of the characteristics of the securities that underlie this portfolio are not cheap at all, nor are they high quality. And so this particular index purports to be a value-based index, but at least based on the valuation metric we've chosen here, and all valuation metrics are highly, highly correlated, doesn't actually load up on cheapness characteristic as much as we might like. Whereas here, this third set of dots is a known quasi-indexer that's trying to capture a value exposure, a value tilt. And what you notice here, when you look at all these dots are all over the place. And they're more reflective of a market cap passive index than an actual active exposure that's trying to give an investor the characteristics that they actually want to own. This green dotted strategy here is clearly just kind of tilting in a direction towards characteristics we want, which is cheapness and quality. But as you know, it's a lot of the mass and a lot of the distribution of the underlying holdings in this index, which there's around 300 of them. They're clearly not cheap and they're clearly not quality. And if we're a value investor and we're going to burn fee capital on things that are supposed to be delivering us the value premium, we want to make sure that those fee dollars are concentrated on exposures that actually, in theory, will generate us some sort of performance over time. Whereas this active share tool allows us to very quickly ascertain who's actually delivering on these types of portfolio constructions and the characteristics we actually want at the holdings level versus those who act like they're not quasi-indexers, but clearly it's very easy to ascertain that they are when we see the visual active share tool because we're looking at the holding level what these securities look like. Same thing here we do on the international side. Again, a highly active international index, trying to get as much cheapness and as much quality as possible. This was measured about a quarter delayed from when this index was actually constructed. So some of these names apparently got more expensive over time. But in general, you see a tilt towards cheap quality. Again, the quasi-active international index is definitely not value. It's not cheapness, it's not quality, it's just a quasi-indexer. And this is the closest thing we can come into that is, sorry, I got another question here on quality. So for here on quality, question from Andrew, we're just using a very simple return on equity calculation. In the future, we'd like to have this tool be user program, where on quality, maybe you don't like return on equity because you believe it is a good quality metric. maybe you like something else. We want to have a capability, and it may not be super robust, at least initially, but to give people options where if they're looking to get a value exposure, they can enter in their own version of quality and their own version of valuation down here. But for now, I'm just showing the tool that we have built now, given the valuation metrics we have loaded and given the quality metrics we have loaded. And that quality metric is return on equity. And again, I'm not arguing that's the best or the worst. It's just a quality metric. And if you believe that cheapness and quality drive future expected returns over the long haul, at least it's a rough proxy for what that portfolio should look like. Finally, here is the passive value, or kind of this definite closet indexing value exposure, these green dots. And what, again, you notice with the green and these orange to light green dots here, they have no resemblance of the characteristics that you actually want to own as a value investor. These are both closet indexing, you might as well buy the International Vanguard Fund type strategies. And the only way you can really ferret that out and get through all the marketing gimmicks and through all the salesmanship is actually have a tool that just calls them out directly. Now we go to momentum, where momentum, I'll orient you here. The x-axis is just generic momentum. This is the 212 momentum relative strength signal that is documented in Drug Addiction Commitment 93, which is on Farmer French's website. This is the quote-unquote momentum effect as is classically documented in the academic literature to represent momentum. That is this x-axis here. So every security, 1 through 1,000, is ranked on this, where 0 is the worst relative strength momentum stock. 1 would be the top performer in the entire index over the last 12 months, skipping the most recent month. Now, momentum quality, which is on the y-axis, this is a little bit more in the weeds and a little bit more esoteric. It's just something that we focus on in our own research, where you have momentum, but then there's the path dependency of the momentum. So how does this security achieve momentum? And one of the things that we find and a lot of other academic researchers find is that kind of smooth or less jumpy and erratic momentum paths tend to drive the momentum effect in the future, as opposed to just generically buying all, the highest relative strength 212 names. So in theory, and based on our own research, and I think based on a lot of research of many others out there in academic literature, the characteristics that drive performance and momentum are, 1, generic relative strength. That's an obvious one. But then at the margin, given your high relative strength, try to make sure you have higher quality momentum, not lower quality momentum. And before I move on, one question here. Another question is, what's the size of each dot? So here, the dots represent the portfolio allocation of that particular portfolio. If you add in market cap, there's a whole nother dimension you can see where a lot of these portfolios are just basically mega cap investors. We don't put that in here. This is meant to capture the portfolio construction. So the dots here are all roughly equal because this is an equal weight portfolio, and you'll kind of get to see the market cap component come through because as I show some of these, closet indexing type momentum portfolios, clearly they have different size dots, and those dots are usually a reflection of underlying market cap, which means they're buying high momentum securities, but they're putting a vast component of the weight into the mega cap high momentum stocks. And so what we see here, this is a highly active momentum fund, 40 security or momentum index, highly active, tilted towards positive relative strength, and tilted towards quality relative strength as much as possible. This is actually a famous index from someone who I'm not going to mention here, but if I said the name, everyone would be like, oh, that's like the momentum gods. And they're as active as you could possibly get from at least from a marketing perspective, but as this tool clearly shows, there's a huge mass of these portfolios that don't represent anything that even reflects the academically documented momentum effect, which is kind of surprising / scary because when we want to go buy momentum that everyone talks about, it's the momentum that presumably that people documented in the research, so the portfolio should actually reflect what's actually been studied, not reflect what apparently they actually do. You know, we don't want to buy what you actually do, we want to buy what you actually say, but it turns out that a lot of funds out there are actually doing something completely different than what they're saying or what they're marketing. And again, here's a closet indexer, a more extreme one. And again, the green and the orange dots, they don't have a huge amount of mass up here in the upper right quadrant, which is ideally where all the exposures of the underlying holdings would be. They're all over the map. So we're not really buying momentum for a large portion of these portfolios. We're basically just buying, you know, more Vanguard index funds. The area where you see it most extreme, this is now the international momentum indices that are out there. And what's presently shown is a concentrated, super active version. It loads for a vast majority of this portfolio on high momentum and high quality. Great. Let's see what some of the other purported momentum funds are doing out there. Well, that's the best we can find. This is like the next closest thing to being active out there. Also a very well-known brand. How does this reflect momentum, the characteristic momentum in the underlying portfolio? Even though it's marketed explicitly as a momentum evidence-based portfolio, the underlying characteristics of the holdings that are in this portfolio don't even match the characteristics of the evidence-based strategy that drives the performance. So clearly out of sample, this portfolio is not going to be representative of the evidence-based version of momentum that has historically been documented by academic researchers and what have you. And it gets even worse when you look at another international fund that is, again, by a very well-established institution that is marketed explicitly as momentum, and it's represented by these green dots here, and the green dots are all over the map. So 90% of the holdings wouldn't even be considered momentum on the generic 212 classic characteristic that academics have documented as driving the momentum effect. These portfolio constructs are being, the signals based on something entirely different, and it's unclear that what they're doing is actually reflective of what they're trying to capture, which is an actual evidence-based strategy that people want to actually own. So this is, again, being marketed as one thing, but only through this visualization tool can we see at a holdings level what is actually going on in this portfolio with how the characteristics of the stocks map into the actual portfolio that we're purchasing. So anyway, that's an intro to this visual active share tool. And again, the intent here is to help investors make more informed decisions about what they're actually buying versus what they're being sold. And this is, again, an R&D technology that we've been building. We've got it set up where you can load any ETF at this point in theory, and then we've have some generic characteristics that we think drive expected performance. But ideally, we want to make it where there can be alternatives here, so a user can put in their own version of momentum that they think drives performance. But again, the main intent is to make a tool that helps people be better investors. So what I'd like to do is just open it up for comment and insights and any ideas that maybe people have out there. There are things you would like to see. This is kind of a crowdsourced technology. So if anyone has anything or input, we'd really appreciate it, and I'll take notes here.
And I'd like to remind everyone that you can notice there is a chat panel over on the right-hand side. If you do have any questions for Wes, now's the time to put them in at this point. But also, let me see. We'll wait just another moment or two for some additional questions. Now I see them coming in. Thank you, John.
Yeah, so John has a question just for audio listeners. Is it your intention to make this part of the tools section of the Alpha Architect website? Likely, however, I have actually been in contact with one of the authors who wrote the original active share paper. Margin Kremers, and he actually has a really cool website. It's called activeshare.info. It's another R&D project, but I want to work with him just because he's the guy that invented ActiveShare, and I think this is a better, more useful way for folks in practice to use it. So I'd like to do something in collaboration with him, and we'll definitely have it on our website. But depending on how my discussions go with Professor Kremers, we may do something in a collaborative environment where he may be able to add his own input as well. And I think that'll make it a better tool, and maybe not be as biased by our input, because we're always thinking about what we think about, but we'd like other smart people have input to make the tool really good. Another question here is, how different do the charts look with alternative projections on the axes? So an example would be like, instead of 212 momentum, use 6-2 momentum, so 6-month momentum. So that's why we want to build this technology where it's flexible, where questions like that can immediately be addressed. And because there's a lot of interesting questions. We think the evidence is pretty clear that over time, 212 momentum is probably the characteristic that drives the momentum effect more so than 6-month momentum. And again, that's not me just speaking, that's kind of, say, the preponderance of the academic research out there. I understand that practitioners often use 6-month momentum. I'm not really sure why, because there's no evidence that that's a better metric, but they just do. So, yeah, they could load more on that if that is in their index methodology of that's how they form the portfolio. But as investors, we want to make sure that the process that whoever is building these portfolios is following is the one that's going to give us the biggest expected chance of winning in the future. Do you think it would be appropriate for me or you to mention IB's mutual fund replicator to help call out quasi-index funds? Sure, I think it's, oh, sorry, that was a private question. But I think it's one of the things on IB, again, I don't get paid by IB, I just like what they do, is IB actually has a mutual fund replication tool, which allows you to go into their system, type in a particular mutual fund you might own, and they have a little optimization algorithm in the background that can show you how to replicate that exposure at a much cheaper price. And I think that's wonderful. And that's kind of what our tool is also meant to do, is just help investors make better investment decisions, understand what they're buying, and not just always being overrun by the sales pitch. So yeah, I'll gladly mention the mutual fund replicator tool on IB, and I encourage all IB users to use that.
Hey, Wes, this is just Emmett. 1 second, just want to jump in. Emmett Pepper, sales rep at Interactive. And if anyone here is interested in our mutual fund replicator, please feel free to contact me, and I'm happy to send you some screenshots of some examples if you want to give me some mutual fund tickers. epeppers@interactivebrokers.com. Thanks. Sorry about that, Wes.
No worries. A few other questions. Let's see here. I got a lot of questions here, so I'm trying to capture them here for everyone. I'd like to see a table to show what portion of the portfolio is in each decile. Specifically, I'd like to see the actual percentage and the target value momentum. Sure. So right now, this is just a visualization. The in-state tool, which we actually have in kind of a beta format, is you can actually hover over every single bubble and see the name, see exactly what portion is in it, and then I think down the road we have to look at the the data licensing agreements with this potential data provider we're working with. But I think in the end we want to also allow people to have the underlying data, so they can actually see it. It has high integrity. They can go replicate it and go bananas on whatever they want to do with it. That is something we have the capability to do, but that gets back to a licensing thing. And with the data provider for all the ETF holdings and all these things, we just have to make sure that would be kosher. But in the end, we would like to do that just for transparency's sake. Oh, they look good. Okay, gotcha. Yes, so someone was saying, hey, it would be nice to have the underlying data and also be able to, you know, put in your own kind of characteristics on the axes, because, you know, one axis might be, like, let's say someone's trying to do explicitly a 2-12 momentum fund, or versus someone else believes that actually 2-6 momentum is much better. So basically annual momentum calculated for relative strength, someone thinks is good, another person thinks 6 months momentum relative strength is the answer. Then clearly someone who's sorting on 12-month momentum is going to look a lot better on visual active share for that characteristic than the 6-month momentum person. And that would be kind of dependent on the user to ascertain what they think is to be the characteristics that drive future performance. And what we're going to try to do is we're going to try to nudge people in the direction with citations to source academic literature, not just some, you know, research thing that came out of a sell-side shop, that, you know, hopefully gives us the backing or the intellectual backing that these are the characteristics that seem to be the most effective, and we recommend you use them when assessing, you know, what these portfolios hold. But we also want to give people the flexibility to, you know, look elsewhere and think about different things as well. Someone asked a question about, you know, our funds. Can't really address that in a public forum just because of the compliance nightmares. But happy to talk about that if you just email me directly. And I think it's on this system here. There's some way to get my email when you register. Feel free to reach out direct with any questions you may have. Another question is, I'd like to see, perhaps with color, the market value of the stocks as well. Definitely, we have that capability now. It's just the problem is we have 3 dimensions of the axis, and so what we want to do is we want to build eventually where you can almost select that 3rd dimension. It could be either the percentage weight of the portfolio holdings, or we could do it on just a raw market cap basis. One of the things we found, and why we don't do it on a market cap basis, at least not in these things, is a lot of portfolios will own market cap related portfolios where they own Apple and then, you know, a bunch of other securities, but Apple is a $500 billion stock and all the other stocks are like $1 billion. So essentially this fund is 90% Apple, and what you see is just one huge circle that takes over the whole chart, which is also an important thing to understand, and that's something this tool will also help the user identify immediately, because you'll see a big dot in the middle, but you also will lose a lot of granular information. So we'll have it both ways, but we didn't go with the default as just market cap weighted here, because there's so many cause indexers out there that, you know, are super tilted towards mega caps because of their portfolio construction, and because those portfolios are basically built to jam a ton of money into them. It just would kind of muddy out all other effects, and you're essentially buying a large cap value fund, which again you could just go buy Vanguard for free. So we don't recommend buying things that, you know, have market cap weighted construction, especially if you're going to pay a lot for them, because they're going to act and move and feel a lot like a, you know, S&P 500 fund. So here's a great question. Someone asked, how do you adjust for securities that are appreciating value, because some stocks they move up and down the decile chain, and ideally in a, you know, a frictionless world, we'd want to always own, in the case of value, the cheapest securities. But some stocks have a great run and they go from being value to growth, but if we don't rebalance except maybe once every year or two, we may be owning a security that actually doesn't hold the characteristic that we know drives performance. And so that gets back to this trade-off that we talked about earlier, where there's always a trade-off with performance on frequency of rebounds here. And I'll go to momentum because it's a much more striking effect. So when you look at momentum results, and we'll just focus here on the high conviction momentum portfolios where there's 50 stocks of the 1,000 securities, we could rebalance that portfolio every month, every 2 months, every year. We could even do it every day. And we've actually looked at daily rebalance value momentum portfolios. And if you believe the characteristic drives the performance, and we're just pulling away frictional costs right now. Well, it turns out to be the case that that's true. Because if you daily rebalance momentum or value, you're always in the securities that own that characteristic at the highest degree, and you're always booting out people that move out of the decile and, keep taking people in that move into the decile. And to the extent that that characteristic drives expected future returns, that's definitely the case. And you see that here, because the monthly rebalance is going to have a much more fresh batch of high momentum names versus a 12-month rebalance momentum portfolio. You might as well buy a Vanguard fund because it doesn't do anything for you. So momentum is a characteristic that decays very rapidly, and if the end buyer of that portfolio construct doesn't understand that, they may be being sold a momentum fund, but it's a low frequency rebalance momentum fund, and they may not realize that the evidence is pretty clear. If you don't frequently rebalance momentum, you're up a creek without a paddle, essentially. It's just a waste of your time. And now you might ask, well, why aren't all momentum funds super high frequency rebalance? Well, the problem with high frequency rebalance is there's a ton of frictional costs, and there's a ton of issues that come with rebalancing too frequently. So you always got to make a trade-off between expected performance and the frictions. Let's see here. Just getting some more questions here. So anyway, to make a long story short on that, and sorry I was long-winded, essentially rebalance frequency is that question for how you keep the characteristics as clean as possible. More rebalance frequency, all else equal, is better, but we need to weigh that against taxes and frictional costs. And just to give you our answer, just from our own internal research, and this is given that we internally don't manage billions of dollars. If we had billions of dollars, I would have a total different response, because in some sense we would almost be forced to move to be more cause indexing. But given we have a lot of runway, and given we don't have massive scalability problems right now, we think the optimal on value is quarterly, and we also think the same on momentum. Momentum monthly is actually, it's fine, it works better, but after the frictional costs and taxes and a bunch of other things, we think quarterly seems to be a good trade-off. For value in particular, if you wanted to, slow that one down and move out to a year, are you going to get hurt in expectation? Yeah. But if you wanted to do this in your own, personal account, if you did a, pretty low frequent, annual rebalance that, incurred tax efficiency around the year-end tax or the 365-day limit, I wouldn't say that was a terrible idea. So if you have a tax wrapper, we think quarterly is better. If you don't have a tax structure, then you could, if you annually rebalance in, say, your own personal account and you did tax minimization, it'd probably be a reasonable approach as well. All right, so another question here. Would it be possible to add a slider to follow the docs in time? Great question, and that would involve on the databasing side, basically building a time series, kind of point-in-time database infrastructure. And to answer that question, yes, that would be a nice to have, but from an engineering technology standpoint, primarily because we're delivering this free, and because it costs us money even just for the data and everything, we're investing as much resources as we can to the extent that this is not our full-time, business. So we eventually would like to build that technology, but it's kind of a lower priority thing. And maybe we can get in cahoots with, Kremers or some other folks out there who can help us drive this effort forward, and maybe they can help, build those technologies so it's not 100% on our shoulders, because to do what you're saying there, to hold like kind of a time series, point-in-time database of how these change over time per fund, definitely possible. It just require a lot more database engineering in time, essentially. So good idea, but on the back burner for the foreseeable future. Future development opportunities to get involved through a blog and comment section. not really sure what the question is, but in general, again, our mission is empower investor education, so we're open to all good ideas, all, counter ideas to what we talk about. So if you ever want to share research, we essentially have a platform. We have a huge audience of people that are really interested in, learning about financial markets and doing evidence-based investing and, trying to figure out what is good, what is bad, what is sales pitch, what is, the evidence. So yeah, if that's what the question is there ability to contribute or share new ideas and thoughts? Of course. And we try to do so with minimal, editorializing to keep the integrity of the, the insight or input. And also, if anyone knows of alternative tools that are trying to achieve the same ends, we're all ears. We've talked to a lot of big providers out there, at least in kind of the retail, low cost space, and we haven't seen it. That's why we're kind of spearheading this effort for the investor community. But if someone knows someone out there or someone who wants to pitch in with development or any sort of expertise, we're obviously open to help on this. So, someone mentioned the portfolio visualizer team. Definitely know the lead developer there. Great guy. He does portfolio visualizer as a hobby. Kind of like we run our tools. It's not a real business. It's more of a kind of our impact and help the world out type business. So yeah, I think portfolio visualizer is great. I'll have to reach out to him and ask him if he's interested in collaborating on it. I think that's great comment from the test share. So any other thoughts or insights or things nice to have or ideas out there that we can help share the gospel about these sort of things?
Well, Wes, while we're waiting for responses to that question, I do have a quick piece of business to do, and I do want to remind you the chat will remain open, so if you've got additional questions or comments, go ahead and enter them now. But I do have that quick piece of business, and that's to ask you for just a half a minute to take a look at the poll and respond. IB's management team requires I run this in each of my events, and you'll notice there are 3 short questions and 2 are multiple choice, so it makes it very quick and easy. Once you make your selections, do click the Submit button in the lower right-hand corner of the screen. And by the way, because the polling panel has covered up that chat panel, if you simply double-click the title bar, you'll get access back to the chat and can send any of those questions or comments. Okay, poll did end, so thank you all very much for participating with that. Now also, I'm not seeing any additional questions come in, but I do want you to know that we have been recording today's presentation and we'll be making it available to you soon after today's session ends. We'll also be posting this on the Interactive Brokers website. Underneath the Education menu, there's a webinar section, and you can locate today's event underneath the recorded button and industry sponsored tab. So thanks everyone. Now Wes, I'm not seeing any additional questions. Have you?
No, I think we're good, and yeah, people can just email me directly if they got anything to follow on.
Okay. Oh, and would you put this on your last slide, Wes, because we actually have contact information that will be included with today's webinar notes. Also want to remind you that there it is, excellent right there. So if you do want to get in touch with Dr. Gray, notice here you've got the contact information. And by the way, I'm also going to put my colleague's email address for Emmett Peppers. And by the way, thank you for your mention of the ETF feature that we have in Trader Workstation. If you'd like to learn more about what TWS or Interactive Brokers has available to you, please contact Emmett for a discussion or even to access a free trial of the TWS platform. So with that, that is going to conclude our event today. I want to thank everyone for your participation in today's session, but also a good deal of thanks to Dr. Wes Gray. Thank you so much, Wes. We look forward to these events.
Thank you, Cynthia. Appreciate you guys setting this up for me and everything.
Oh, certainly. And by the way, as you exit today's event, remember that a copy of those webinar notes will be available, and watch your email this afternoon for a direct link to today's recorded playback. So with that, we are going to end today's session. Have a great day, everyone, and keep in mind to please trade smart. Thanks all. Have a good one.